Welcome to the Deep Dive. Today we're getting into a really fascinating story. We're looking at the Q3 fiscal 2026 earnings for Domo Inc., which dropped after the market closed on December 4th.
Yeah, and this one is necessary because it was, just one of the most conflicted reports I've seen all quarter.
Conflict is a good word for it.
You basically have two completely separate stories happening at once. On one hand, you have a textbook operational beat that the market just completely ignored.
Brutally ignored.
And on the other, you have this strategic shock that just sent the stock tumbling. So our mission today is to, cut through that noise and figure out which story really holds up long term.
Okay, so let's unpack that. Because if you just look at the numbers, the financial statements, Domo really delivered. It was, like you said, a clear operational beat.
Absolutely. Let's start with the bottom line, non-GAAP EPS. That's earnings per share. It came in positive 1 cent.
And the consensus was what, a loss of 5 cents?
Exactly. So they beat that by a mile. And that's actually their second quarter in a row of positive non-GAAP EPS.
And the revenue was solid too. Came in at $79.4 million, which was just a hair above what people were expecting.
Right. But the real story, or at least the one management was pushing, was all about discipline. They hit a record high non-GAAP operating margin.
What was the number?
6.8%.
Wow. Okay, so for a growth-focused software company to hit a nearly 7% operating margin, that signals a huge shift in focus, right, towards profitability.
It's a massive shift. And usually the market rewards that kind of discipline.
But not here. And this is where it gets really interesting. Despite the beat, despite the record margin, the stock dropped something like 23 or 24% the next day.
On huge volume, too. It was a classic case of the strategic shock just completely overriding the financial success.
Operationally upbeat, but strategically cautious.
And right now, in this market, caution is basically kryptonite. The market punished the caution and completely ignored the operational wins.
So this brings us right to that core tension, that rule of 40 dilemma that so many of these companies are facing.
Precisely. The idea that your growth rate plus your profit margin should add up to 40, Domo is absolutely nailing the margin part.
But the growth isn't there to match.
That is the billion-dollar question. They've proven they can be profitable, but can they grow while being profitable?
All right, so let's dig into that operational win first. Management's whole thesis was that their new consumption model can work in tandem with margin expansion.
And that margin story is just undeniable. They generated $2.1 million in adjusted free cash flow, FCF.
And just for our listeners, FCF is the cash they generate from operations minus their big capital spending. It's a key health metric.
And that number is a stunning $15.8 million improvement from last year.
A huge swing.
It is. And they're now confident enough to say they expect to be free cash flow positive for the entire fiscal year. For the first time ever. That's a huge milestone.
And this is all happening because of that big strategic pivot you mentioned, the move to consumption-based pricing.
Right, where customers pay for what they use instead of just a flat fee. And the adoption of that model has been, phenomenal.
So what does that look like on the books? What's the number?
Domo reported that 80% of their annual recurring revenue, their ARR, is now on these consumption contracts.
80%? I rember when that number was in the single digits just a couple of years back.
It's a lightning fast shift. And they expect to be over 85% by the end of the year. But the key health metric, the one you, the listener, should really lock onto, is net recurring revenue, NRR.
Right. So that tells you if your existing customers are spending more money with you over time. Anything over 100% is the holy grail.
Exactly. And while their overall NRR was 95%, which means they still have some churn,
okay,
the NRR for just the consumption cohort, so the customers on the new model, was robustly above 100. It hit 106% in Q3.
Now that is a critical piece of data.
It is. That 106% confirms that for the customers they've moved over, the model is working. It's creating healthy growth and expansion.
And you see this reflected in the actual usage metrics too, right?
You absolutely do. Monthly unique users were up 10% year over year, but the really eye-popping number is around their strategic product, Cloud Amplifier.
Right. Cloud Amplifier unique users are up. What was it?
A massive 450% year over year across more than 350 different customer accounts.
Okay, let's pause there. For anyone not deep in the weeds on Domo's strategy, what exactly is Cloud Amplifier, and why is that 450% growth so important?
So Cloud Amplifier is basically Domo's way of playing nice in the modern data world. It lets their tools query and analyze data right where it lives.
In the customer's own cloud data warehouse, like a Snowflake or a Databricks.
Exactly. So Domo isn't making you move your data. They're just providing the orchestration and analysis layer above everything else. That 450% growth proves that strategy is working. It makes them a partner to the big cloud guys, not a competitor.
So, okay, let's recap the good news. Record margins, positive free cash flow, 106% NRR in their key cohort, and viral adoption of their main strategic product.
It looks like a fundamentally healthy company on paper.
So how on earth does the market justify a 24% crash? This had to be all about the headwinds.
It was, and the problem was growth, or I should say the severe lack of it. Q3 billings, which is a good indicator of future revenue, were flat year over year.
And they missed their own guidance.
Which is a cardinal sin. And management's explanation was elongated sales cycles.
Okay, that's maybe the oldest excuse in the software playbook. Is there any reason to believe them this time around?
It's a fair question, and investors are right to be skeptical. But their context was interesting. They linked the longer cycles directly to that cloud amplifier strategy. They're arguing that these new partner deals with Snowflake and others, they're just massive multi-stakeholder deals. They involve the CIO, they're complex, so they naturally take longer to close.
So the claim is the deals are higher value and stickier in the end.
Yeah.
But getting them across the finish line is just slow and messy right now.
That's the argument. The problem is convincing the market that this is temporary friction, not just a permanent drag from bad execution. And the market clearly voted for bad execution.
And then they compounded that problem with the guidance reset.
Yeah, the Q4 revenue guide was a little soft, and they tightened the full year EPS guide downwards. It's that classic beat in the lower scenario that the street just hates.
That alone would have been enough for a big drop. But then came the shockwave, the leadership transition.
The one that really became the focal point after the call, the announcement about founder and CEO Josh James.
Right. He announced he's reducing his day-to-day duties to focus on his health and recovery from alcohol substance abuse treatment.
And while he said he's maintaining strategic oversight, it's a huge disruption. Any founder CEO stepping back, especially during such a critical pivot.
It just injects massive uncertainty into the story.
It does. And the market saw this dual shock flat growth and a leadership transition as compounding the execution risk right when they needed a steady hand.
It's that human element, isn't it? It intersects with the spreadsheet, and the market's job is to price in that risk. And the perception of instability just overwhelmed that fantastic 106% NRR number.
Precisely. The stock's price action screams maximum skepticism about their ability to stay focused and hit those long-term goals.
So let's look ahead. What's their counter narrative to all this? How do they get the growth story back on track?
It's all about that positioning as the orchestration layer with Cloud Amplifier. They are not trying to fight Snowflake. They're sitting above them. Management argues this neutrality is their key advantage, and that's resonating.
It seems to be. They won that CRN Product of the Year award for their AI product.
Right. So the strategy seems sound, even if the execution is choppy, and they are sticking to their long-term targets. Exit fiscal 27 with 10% billings growth and 10% operating margins. That's the promised land.
But they need to show some progress soon to have any credibility. Do they have visibility into Q4? Any sign they can pull out of this slump?
They gave specific guidance. They're guiding for Q4 billings of around $107.5 to $109.5 million. And this is a critical number for them to hit.
Why is that?
Because the midpoint of that range represents 6% year-over-year growth. If they hit that, it would be their highest billings growth in over 3 years.
So they're explicitly promising a reacceleration.
They are.
Yeah.
And to give investors some comfort, they said a higher percentage of that Q4 number is already protected by existing multi-year contracts.
A little more visibility.
Exactly. They also hinted at some bigger strategic catalysts on the horizon, like OEM or investment deals with the big cloud vendors.
Because of that neutrality.
Yes. If they land one of those deals in the next year, it could be a massive re-rating event for the stock.
Okay, so this stock is basically being priced by fear and uncertainty right now, not by that underlying consumption health.
It is a super high tension situation. The contrast couldn't be starker.
All right, let's transition to our final segment. This is not financial advice. And we have to remind you, our listener, everything we discuss here is purely for educational and entertainment purposes. We are not telling you what to buy or sell.
Absolutely. But given that 24% haircut the stock took, the valuation is clearly pricing in just maximum pessimism. And that kind of sell-off creates some interesting conditions we can analyze for an outrageous but plausible trade idea.
Okay, so what's the core thesis of the trade?
The thesis is pretty simple. The market overreacted to the near-term noise. That underlying consumption engine, with its 106% NRR, provides a strategic floor that is higher than the current stock price.
And the volatility is sky high.
Exactly.
Yeah.
The fear has made options pricing artificially expensive, so the trade is designed to capitalize on that fear while still making a bet on that fundamental health.
So how would you structure that?
It's a structured options play. You'd look at selling short-dated, out-of-the-money puts and calls. You're effectively harvesting that high volatility premium, betting the stock stays in a range in the short term.
Okay, so that's capitalizing on the fear. What's the directional bet on the recovery?
At the same time, you'd buy long-dated call options, say 18 months out. This is your bet that once the Q4 billings reacceleration hits and the CEO simulation stabilizes, the stock can recover.
A bet on a rebound toward those lowered analyst price targets, maybe back to the mid-teens.
Exactly. It's a high-risk bet that the operational health, that 106% NRR is the real truth, and that it's durable enough to eventually override all this current strategic chaos.
A structural bet on their internal success, basically.
Assuming the flat billings are just temporary friction, yes.
So to summarize the critical conflict for you, the listener, Domo proved this quarter it can achieve real, software-like margins and free cash flow. A huge win. But the lack of growth and the leadership uncertainty triggered a severe, punishing market reaction.
And the next few quarters will answer that central question. Are these long, partner-led sales cycles truly the key to unlocking reaccelerated growth? Or are they a permanent drag that will keep them from ever hitting that 10% growth target?
That's the essential question to think about. Thank you for joining us on this deep dive. Remember, all information is for educational purposes only. Do your own diligence, and we'll catch you on the next one.